I'm personally against it, so you could be for it. Is that they finish their engineering degree and immediately go for an MBA, no work ex in between.
No, I think work experience is key. I do personally believe before the MBA.
How would you explain to someone what venture debt was?
It's a 0 or 100. You're
Correct.
betting that this thing is going to go to 100. You're not betting for a 10 or 20.
And then what was the trigger that got you back to India?
I'm sorry, but seeing kids on the New York subway, I was a little scandalized. So I think I started valuing the Indian sort of family values, the culture. And so that was my primary reason for moving back.
Because I remember I've seen Seed Fund's portfolio.
Yeah.
Seed Fund had a very exciting and interesting portfolio.
The partners there were pioneers of what Seed Fund investing is. They were the first, which is why they didn't have to even think of a name, right?
I think we've also glorified founders into being sort of mini celebrities too early. Before someone's truly successful.
Blame social media and LinkedIn and
partly,
Twitter, or is it just PR? I don't know who to blame for that.
Founders need to be extremely careful and respectful of debt. Hello and welcome to another episode of The Money Talks. And today we've got, by very popular demand, by the way, Tarana Lalwani. So Tarana I know each other because I was an angel investor and I met her. Mumbai Angels. And I knew her before I made my first investment. Right? And Tarana at that time was starting her venture journey, which I found out later with Seed Fund.
Yes.
And so we've known each other on and off. And we've had, I think we keep messaging each other on social media platforms to catch up for coffee, and then we do it once every 2 years. So thankfully we had one such coffee conversation about a week ago, and I said, "Hey Tarana, this Sunday I'm doing a podcast. Can you make it?" And she was gracious enough.
Not gracious. I said, I might as well. Others I'm not going to get a chance again for 2 years. He's too busy.
So without further ado, Tarana, how are you feeling?
Good. I'm a little nervous since I don't know what you're talking to me about, but fine.
Well, I'll try to keep it nice and slow. But that getting said, so Tarana, you have a very interesting journey, by the way. You spent a lot of time in the US. Mm-hmm. You worked in the US. You went to Columbia. Prior to which you were working for Morgan Stanley.
Yep.
And then you worked a couple more years before,
after business school. So I did ABS, CBS, mortgage-backed securities. So I'm responsible, or was part
at least started the Big Short.
Yes. I interact with some of the characters. I think I was telling you that.
Really? Oh, wow.
Yeah. I interacted with some of the characters. Greg Lipman being one. Very charming.
But that getting said, it's what was it like to do business school? I think this at the time you did, right? Because not many people from India were heading to those shores at the time. And then India wasn't really, just in the last one of the podcasts we were discussing, that India at that time was like a $300 to $400 billion economy, but not really on the global stage. And from roughly like a $400 per capita GDP, right? And then you come from that kind of an economy, going to Colombia. And how has that been different compared to when you go to the US now?
So, to be honest, I mean, I'd love to give some story that it was, a huge life-changing experience, and I, transitioned, and but the fact of the matter is I did grow up in a tier 1 city in Bombay, even in the 90s, right? And then I went to boarding school in Court, which was a privileged environment, then did my undergrad in the US. So it was not such a culture shock or a change for me. I was living in New York and working in New York. So from that perspective, it was life as usual, if I have to put it that way. But I was very clear I wanted to do an MBA. I think from the time I was like maybe 8 or 9 and I knew the name Harvard Business School, I was very clear.
Really? Wow. From that time.
Yeah. I was very focused. My ambition was literally, and I have to, sometimes I say I should be thanking some of my guy friends. Sometimes I think I should be abusing them, because till I went to boarding school, I was very clear I was doing an engineering degree, going to join my dad in business, take over the family business in manufacturing and run that. Then I go away to Cody, start getting little feelers of Wall Street. The movie Wall Street with Michael Douglas came out. Have all these boys talking about finance. And so then, of course, went the finance and business route. Today, I think everyone should do an engineering degree.
You think
like
so?
Most Indian parents. Okay. Yeah. I think it's very important to have a technical degree. So I think the journey started from there, that, I was very clear I want to do an MBA, which is why I even stayed back in the US after undergrad. So initially I thought I'll come back home and join again. Like most of us, we think we'll come back and join the family business. But then everyone says, you have to get the right work experience to go to business school. So I think what's changed from, if you ask me, when I went there to what India being on the map today Indian organizations are recognized, right? Going to business school, maybe a little more of a task, but organizations out here, the names, you'll recognize a Flipkart or a Piramal or a Mahindra or a Tata.
Reliance, yeah.
When we went, it was like, okay, you have to go to one of these tier, sort of do the consulting route or the investment banking route and then go to business school after 2 years of experience. That was sort of the track that you did and way to it. And so I followed that path. And that's what...
And interesting enough, and maybe because we just talked about career paths, right?
Yeah.
I think many people... and I'm personally against it, so you could be for it. And is that they finish their engineering degree and immediately go for an MBA, no work ex in between, right? And then they finish this this entire journey of learning, right? And then they have zero work experience, and they wonder why they're getting hired for starter roles, right? What is your view on that?
No, I think work experience is key. I do personally believe before the MBA. I think it should be. And of course, there are exceptions to the rule, but I think having some work ex gives you a perspective in class discussions, right? Like when I was in business school, one of my classmates was a banker and then he went and worked on an oil refinery.
Really?
Like literally went and worked on a refinery where he was chugging and getting oil out of the sea. So, I mean, it gives you a different perspective. So I think having that is very important. I think that's what I actually value of the US MBA is that, people came with work ex, right? It was a requirement. True. And you had kids from diverse backgrounds, right? Somebody came from a technical degree. Someone came from marketing. Someone came from, one of my classmates was a journalist with the Washington Post. So I think that sort of gives you a very broad sort of landscape of what is going around.
I think it also makes a difference because when they're talking about case studies, right? you've actually seen some of them in real life, right? And you're not just theoretically talking about things.
You're able to bring a perspective in, which otherwise, as when you've just done learning and come, it's all theory, it's not practice.
And what about the other side now? Once you finish business school in the US, most people would love to come back to India right away.
Yeah.
Both of us are in the same boat that we spent a lot of time in the US before coming back.
Yeah.
And we really went through this US experience as many should, I believe.
Yeah.
But did that have an impact on you eventually when you came back?
So I think, again, I stayed back because partly if you, again, your life takes its different turns, right? When I went to the US, my parents didn't think I'd come back. Even though I said, okay, I'm going to come back and join the family business and I want to do this because it's my dad's baby. My parents had sort of assumed this kid of ours is so obsessed with the US, she's not coming back. And after my MBA, I thought, okay, it's good to get my green card. And I want to get some work experience. I've again done this MBA. I should get some work experience and then move back. So that was the plan.
Achha.
Of course, 9/11 hit. Getting a job as a foreigner is not easy. So I stumbled into ABS, CBS, sort of mortgage-backed securities. It was not something I was planning to do. My intent was, okay, I'm going back to hardcore banking after business school. And it just so, I remember when I was in business school, a lot of my classmates were like, why do you want to do investment banking? The lifestyle sucks. Why don't you go and do sales and trading? It's a better lifestyle. I'm like, dude, I'm not dealing with people. I'm not a people person. I'm sticking to numbers.
Wow.
And I'm
considering the role you eventually took.
Yeah, exactly. But that's what, and then I was, of course, as I said, 9/11, stumbled into this role. And the first week I was in this role, my boss, really super guy, Greek guy. Actually, I learned a lot from him. He's like, okay, 1 week in the job, go to the S&P conference. All those conferences and the great Big Short, go. I'm like, go and do what? Go and meet people. And I'm like, are you kidding me? Like, I don't know what am I supposed to do? And it was an experience I learned. I had to handle people. Yeah. My job after business school was literally managing people, managing the traders that we dealt with, the issuers, the mortgage back, the credit committee, and sort of putting the whole package together.
I think that's the exposure of the US style, right? They just throw you into the fire and say, listen, figure this out.
Yeah. And he was a fantastic boss. Like I said, fantastic. Like where you needed help, he was there for you and then he'd throw you. But for me, that was a learning. One, it really got my game up on people skills. But two, I think just being in an environment where you sort of had to go and just sort of, I wouldn't say adjust, but learn to mold yourself.
Right.
It changed me as a person. So.
And then what was the trigger that got you back to India?
So I knew long term I wanted to move back to India. Achha. It was more cultural. For me, I think after being in the US and I'm sorry, but seeing kids on the New York subway, I was a little scandalized, and I was like, okay, I cannot raise kids here. At least at that point, I was like, okay. And long term, I think I value the Indian culture. I think, for all the chaos that we complain about, family interferes, society, so judging and all that, I think I like our culture because it's there's no loneliness. People are there for you.
Correct.
I mean, that's a big reason our depression rates are so much lower. The suicide rates are lower in this country, right? So I think I started valuing the Indian sort of family values, the culture. And so that was my primary reason for moving back. And I thought I want to come back with a investment bank or an investing role. I met Rakesh Mathur, who is the founder of Weburu, SMS Gupshup today. And he made me an offer, and I came back in a very sort of non-traditional role of doing biz dev for Weburu, which meant going to Taiwan to meet OEM manufacturers. So I sort of stumbled into the venture ecosystem. It was not planned.
Because after that, you did Sky Advance again as a senior VP.
So to be honest, that all of that was sort of finding my footing after moving back home. I worked at Weburu for a year, very early days, was not doing much. Quit, and then global financial crisis hit, and I thought I was going to go back to banking or into financial services. There was not much happening. There was no jobs, and especially not in India.
Yeah, there was a chance there were no banks.
I saw the Lehman and Ware. So a friend of mine who had this thing called Sky Advance, he was doing some deals on a managed basis, got involved there. Parallelly, Mumbai Angels came into form. So I was dabbling and wasting my time, but it all worked out. Got active with Mumbai Angels. That's how I met you. And then helping a friend with his education venture. He was landscaping the whole education market. This was pre-Byju's and Akan. This was Everon and Educom days. And from there, started looking actively at angel investing, or rather these companies. And I realized, okay, I don't have to be a techie, because my perception was, you have to be an engineer to do venture investing.
That's been the common misconception, yeah.
And I realized you don't have to. And so then got active in early stage investing. I started enjoying meeting founders, learning about interesting ideas. And honestly, it was an eye-opener for me in a lot of ways. Again, living in our bubble in Bombay, you think everyone from IT is a geek. You don't realize that there's this other world that exists. Like, even when I was at Weburu, there were kids who were grade 8 of guitar and piano and did different things. They didn't just study. Like, they weren't just nerds. And so I think it opened a different world to me. And then I ended up at Seed Fund. And then spent 6 years.
And interesting, Seed Fund and Mumbai Angels were in the same building, right?
Yes, but that was much later. Mumbai Angels came there much later, actually.
Oh, really?
So we were there much before Mumbai Angels came in there.
And interestingly enough, because I remember I've seen Seed Fund's portfolio.
Yeah.
Seed Fund had a very exciting and interesting portfolio.
Yeah. We were technically, I mean, not me, but Praveen Gandhi and those guys, the partners there were pioneers sort of what seed fund investing is. They were the first, which is why they didn't have to even think of a name, right?
And you were there for 5 years.
Yes.
What was that like? You were a principal there for 5 years. You managed and executed multiple transactions. Some of the companies that's also on your LinkedIn profile, Vunik, My Dentist, Heckley. And many more.
It was great. I mean, it was a different era. It was truly buy side, and you had someone like Praveen Gandhi, who was the managing partner. You had people coming to you. I didn't know, it was truly buy side. Founders came to meet us. We would sit there in the conference room and discuss what they were. Not that we were mean or something, but it was truly buy side, right? I didn't know what was going on. And today, I think investing's become a bit of sell side, right? Where you're going out. It was more inbound coming in. It was an interesting era because I think the quality of founders, I'm not going to say that the quality has changed, but the values have changed. The founders we met, they were not so caught up in the valuation game.
True.
They were truly passionate about what they were building. Today, I feel that's a little skewed.
I also think that there was nothing called an SHA, right? I mean, whatever you gave was the SHA. I don't think there was a lot of negotiation on...
No, that still happened.
Really?
That did. Not as much maybe, but that was
maybe
still
because
there.
I was, Anil used to come between, in between, so I didn't see it that much. But I definitely feel that there's a lot more education, but there's a lot more misinformation as well that flows in the ecosystem today compared...
100%. 100%. I'm telling you, like Vunik, Sujayat, we were the first term sheet. So I literally educated him on tag, drag, lick, pref, all that, right? And I saw this founder go from, a company where we gave our first term sheet to at one point being one of the most chased companies with having, peak 15, which is, Sequoia, which is now peak 15, etc. on its cap table. But this founder's behavior and demeanor never changed.
Wow.
When he was most chased also, he was reachable. So I think that sort of value, today it's a little mixed bag, I feel, with founders.
I think we've also glorified founders into being sort of mini celebrities too early. I mean, that's my personal opinion that, that the game of entrepreneurship or the journey has so many ups and downs.
100%.
And rato rat, overnight you can find your business gone.
Yeah,
right?
yeah.
And I think before someone's truly successful, we sort of glorify them into 30 under 30, 40 under 40.
Yeah. I've completely. And I think unfortunately, like you said, it's become instead of just focusing on the business, focusing on let them focus on what they
Correct.
build. We get caught up in all the sort of optics, of what's going on around us. And I don't know if partly blame social media and LinkedIn and
partly,
Twitter, or is it just PR? I don't know who to blame for that.
It used to be so difficult to get space in a newspaper in 2012, even if you did a 2 crore round. Today's, today newspaper, like if it's less than 1 million, you don't even, it's not happening, right?
No, when Seed Fund did the exit for Red Bus, 800 crores, it was big news.
Absolutely. Wow. What was that like? Because, until then, and unfortunately, maybe because we get clubbed with private equity at most times, VC has always been looked at, this PEVC is sub-teen returns. Yeah. But I don't think that is the case when it comes really to VC, pure VC, right? And how was that like to finally go, listen, here is a company we exited and made all this money?
It was.
Because Seed Fund has a fantastic DPI from what I remember.
It was a really significant number and meaningful.
Were you involved in a lot of the investments or a lot of the divestments after you joined?
So I was involved in some investments and then not too much on the divestments because other than Red Bus, Karoli, we didn't have too many. We had a few small ones, but so it wasn't a function if I can't take credit for that. Okay. So I think Praveen Gandhi was the key driver in a way, since he was.
That is a great name, Seed Fund.
Yeah. I'm saying no, we didn't have to come up with a name. It just flowed naturally.
Yeah, I think this was around the time even Morpheus was a big thing back then.
Yeah.
So, and then, you went on to join Inovan Capital. Mm-hmm. And now that's a big switch. You go from a seed fund to now saying, I'm going to start doing venture debt, right? Completely on the other side. In 2017, debt to startups was not an unknown thing. Forget about venture debt, jiska naam kisi ne suna hi nahi tha us waqt tak.
Yeah.
What was the, big switch that happened over there?
The honest answer is Seed Fund was not raising the next fund.
Achha.
And I was pretty clear by then that I wanted to be in the ecosystem because I genuinely, and even today I do enjoy meeting founders and learning what they're building. And honestly, if I had a great idea, I would go out and do something, but I don't. So what's the next best thing I can do is I can piggyback off these founders and my claim can fame to be like I'm involved with them as a early stage investor, angel investor, or giving them debt. So Seed Fund was not raising another fund. It was not easy, or there weren't too many opportunities to make the lateral move to other equity funds. And so I stumbled upon an opportunity at Inovan. And
and you started out as a senior director,
yes,
right? And but how, like, what
director? I think not senior director. I don't remember now, but I just want to be clear in case.
But that getting said, Tarana, it was, how would you explain to someone what venture debt was in 2017? Even today, I don't think many people understand. But in 2017, when most people were still trying to understand what venture capital is, you were talking about venture debt. Right, which is like, and to many, right, and I maybe present company included, it was like, how do you trust the balance sheets that they can even manage this kind of debt, even if it is 1 crore? How are they going to pay it back? These are inherently loss-making businesses. I
think venture debt, it was a little bit of a mind shift change that I had to make, because on the equity side, and especially early stage equity, it's a 0-100. You're
Correct.
betting that this thing is going to go to 100. You're not betting for a 10 or 20 or either, right? Or even like, okay, let me get my capital back. It's like all or nothing. 2, I think when you're on the equity side, it's a lot more strategic long term with the founder and the company. You're literally married to it. On the debt side, you're thinking it's a little more thinking, okay, 0 to, will this company be around for the next 5 years? Because my debt needs to be paid back. And will my debt be paid back in the next, because our tenor of the loan is anywhere from 18 months to 36 months. So that's my first sort of train of thought that I have to make, that, okay, will I get my capital back, my debt back? 2, I mean, at least on the early stage side, and not so much for growth, you forget what a balance sheet is. I mean, I remember there were companies, even in our portfolio at Seed Fund, where actually they were not burning that much on the P&L, but they had working capital cycles where the cash was going, and we were missing that as investors at times. And even though I did accounting in undergrad and had done banking, I'd forgotten what a balance sheet was. So I think that was the other piece that I had to sort of go back
so critical though, right? I think over a period of time, and I think maybe over the last 3 or 4 years more so, is you start to understand what working capital, how difficult and important, I mean, how difficult it is for a business
to manage,
and secondly, how important it is, right? Because you can have fantastic, like you said, fantastic P&L numbers, but then you start scratching to the numbers and realizing, operating cash is still negative. Because you're not getting paid on time, or you're not getting paid.
Finance 101, cash is king. So I think that was the second sort of reminder. And the way to look at venture debt is not that it's a replacement for equity. Companies still have to raise equity. It is more like a top up to your equity round. So a lot of the startups, unfortunately, will not get bank debt because they're not profitable. They don't have hard assets. Banks don't know how to underwrite them. So they say, okay, we cannot give these companies debt. But if it's a brick and mortar business or a business that has a working capital requirement, seems like a waste that you use equity money for it, which is where venture debt plays a role. So we're sort of, okay, what we say is, but we're not a bridge loan either. We're not something where we'll come in with a company with 4 months runway and say, okay, between 2 equity rounds, let me raise some debt. It is basically, it's more to be used as a top-up to equity round where it helps the founders and other stakeholders like small funds like us not to dilute, right? Or dilute less, because it says, okay, let's use this debt money. We have equity. We'll be operational for the next year, 18 months. Let's raise some debt to either accelerate our growth, or if we have this working capital or capex requirement where we can use it.
So you said a very key word, which I think most founders need to understand. You said underwrite. Right. And I don't think many founders understand what underwriting is, especially from a debt perspective. Right?
So when we underwrite, so as equity guys, you're underwriting the business, the business model, the vision, how big is the TAM. And we're doing all that as well. But there I'm piggybacking a lot on the equity guys. What we follow very closely is the cash flows, ideally month-on-month cash flows, because I want to see that this company knows that it's going to be around for the next year or 18 months, where they're managed to sort of build this business, and that they'll have the ability to raise the next round of equity. Because the longer they stay around, that's the way they'll repay my debt. Because ultimately I'm debt. I have to be paid back.
That's true. And that's the important part, right? That you have to be paid back. The venture capital guys can write it. They can write off things, and because they have their moonshots, right? If in a venture capital portfolio, out of 10 or 20 companies, even if you have one that takes off with 100x, it's literally going to pay everything else off.
But here, that doesn't happen.
You're never going to get, because even if the company, and that's the benefit, and maybe the curse of venture debt is that on at least for the founder, you can pay back this money and you're done, right? And that dilution is saved. But at the same time, if you don't pay back this money, right, then they can exercise, because the debt guy gets paid first on anything. And for you have to make sure, that's why you were saying underwriting, that they pay you back.
Make sure and all that. Ultimately, we're all part of the ecosystem. We do try to work with our founders when things are tough. So we're not loan sharks either. Maybe we should be at times, but we're not. I think it's balancing. Ultimately, everyone has to coexist. Where I think founders need to realize is that this is debt. It needs to be repaid. And so they have to think about it responsibly. And even my peers, and including us, we're guilty. Sometimes we do push debt on companies when they shouldn't be taking debt. And I think that's what everyone needs to sort of recognize. When should the company raise debt? How much debt? Sometimes we get carried away. And I understand founders sometimes are desperate for capital. But I think they need to recognize that I need to fund this with equity or I need to fund it with debt.
And I also think sometimes, and I've heard this before, simply maybe 12 months ago when money was flowing so quickly and so fast, thick and fast, that most of the founders started treating venture debt also as venture capital.
Yes.
Right? As though that, they could also put that money to work in very long-term projects or very long-term expenses, or even towards marketing and branding, which is going to take a long time to pay back. Far before that, you need to be paid back as well.
Some did. I won't say a lot. And this was, I don't think, again, this was even just the market dynamics. I think this was just everyone, just the gold rush, right? Unfortunately, capital was cheap. And so everyone was sort of
And there's
being
a-
irresponsible,
and there is a big
including us capital providers on the equity or debt side.
And there's a key difference between venture or debt from a bank and venture debt from a fund.
Yeah.
Because you're looking for a kicker, right? That's the difference.
There are a couple of key differences. One, banks definitely put more stringent covenants, and bank debt cannot be used for acquisitions, venture debt can. So that's one big advantage to our... And because we put less stringent covenants, and we understand, right? Unlike, and it's not a bank's fault, banks' risk appetite's different. They are answerable to a lot more people, and they're a bigger organization. Now, tomorrow, if a founder's breaching a covenant, who's he going to reach at the bank? And who's going to make the decision to say, okay, we'll waive off this covenant? At Inovan, they can reach out to me and say, okay, you know what, Tarana, I'm raising money, but this month my debt to equity may be a little off, or my cash balance is a little off. We'll work with you. We understand, okay, you know, it's an early stage company.
You won't report that as an NPA or something?
Yeah, it's an early stage company, right? We understand things are moving, things, you know, we're more flexible. So we're slightly more expensive than a bank, but you're paying for the convenience and flexibility. But as I said, no, we don't usually put stringent covenants. We work with you. You can use us for acquisitions. But the equity kicker piece is not really, I mean, sometimes even banks take it, I think. But generally, it is what we hope will make up for the sort of the risk we're taking.
Acha.
So that's what it is. So the loan is a plain vanilla loan with a coupon. We do working capital lines as well with a coupon. And then we have this equity kicker, which is generally 10% of the loan amount. So the way founders need to look at it is, like, if they took $1 million, you know, what they would be diluting for the same $1 million versus $100K for that equity kicker. So it's significantly almost 1/10.
And so when a founder approaches you, and imagine there is a founder listening in today, thinks that, you know, I think I'm ready for venture debt. Right. And so I'm going to reach out to Tarana. What are the 5 questions they should be prepared for in the first meeting that you are definitely going to ask them?
Okay. Wow, you make me sound... Well, it's first of all, I wish I was... we're not, again, as I said, we're not interrogating them. It's a partnership.
Yeah.
So one, I want to understand the business. What are you building? So similar to the equity guy, what are you building? Quality of founder? What sort of, you know, where are you in terms of other competitors? How big is this market? So understanding broadly the business. Where I dig deeper a little bit is to understand, okay, are you coming to me as a bridge loan? Or, I mean, do you have 3 months runway, 12 months runway? So that's one of the key factors. Then who are your equity investors? Because I do piggyback on them for a governance, for their DD, because we don't do extensive DD. We sort of rely on the equity investors that they've done their homework. So who are the investors? Sort of who's on the board? What, you know, is there governance? I mean, tomorrow they take my money and vanish, I'm in big trouble, right? So that's sort of the second tier. And then third, we then start underwriting the business. So those are I would say there are 3 questions. One, what are you building? And similar to an equity guy and the sub questions, how much runway do you have? Because I do, it's irresponsible. If I give a company that has 3 months money in the bank, I'm accelerating their death instead of helping them.
Correct.
Because if things don't go right, they've just incrementally taken on this liability which was not needed. And
Go ahead.
And 3, just looking at, is there an institutional equity investor in there? Because I need that from a governance and DD perspective.
And when we were speaking earlier to this point, you said there's also a sweet spot of when the founders should reach out to you. Because the common misconception, again, is to reach out to a venture debt fund right when you're raising venture capital. Or like if you're raising a Series A, reach out to Inovan at the same time. But when we spoke a little earlier, you said, listen, wait 2-3 months after the round is complete and then reach out to us.
Well, I wouldn't say wait 2-3 months. I think it's about how much runway do you have. Now, if you have 12 months runway, you should take it with the equity round. But if you have 30 months runway, then wait 3 to 6 months.
I see.
And then also depends on what tenor you want. What is the use of the debt? You know, is it working capital?
What do you think should be the use of the debt?
So, I mean, again, the use generally, I mean, for working capital, capex and acquisitions, it's a no-brainer. Why use equity money? But there can be cases where a company, for example, the founder wants to raise 5 million because he wants to go into, say, 3 geographies, and he believes that's when his risk return profile of the company changes. But he's getting interest for 4, or he's getting interest for 5, but the valuation's not what he likes. So then maybe raise that incremental 1.5 million in debt with the equity round, or a couple of months before or after, start the conversations, and then you can raise it. Where I say the companies, you know, you don't have to raise it with equities. If you have, you're raising money and you have 36 or 30 months of money in the bank, I mean, don't take it. And for this, all my peers are going to come and kill me. Anirudh, you better not put this in.
And the question there being, does raising debt from you because I think your Inovan is initially an NBFC. Does it also raise the credit profile for the company?
It can help them with discipline. So again, we were an NBFC, now we're an AIF fund structure. Though we still have the NBFC vehicle. But yes, starting to take debt from any one of us helps build your credit history, right? Similar. So it brings so it does bring a lot of discipline into companies as well, irrespective of the vehicle. Plus, it does give you credit history. So those are sort of the two advantages.
And I've noticed that most venture debt funds, and I'm sort of generalizing here, have also started some sort of a venture capital business also on the side.
Couple of folks we haven't, no, and I don't think we will.
Why would you not do it?
I think two things. One, I mean, there's enough to do in the debt piece. And then two, I mean, it might create a little bit of, today we work with our capital equity investors as partners. Wouldn't be so great to have them perceive us as competitor, right? So I think it's a little tricky. I'm not saying it may never happen, but I mean, I don't know, we love it because I still think the equity has its own.
And we're going to come to your own angel investment journey, which is very, very interesting. But coming back to the venture debt, which was the first deal that you did in venture debt?
So the first deal I did was Porter. Yeah.
And
I'm very proud of it.
And like what was that journey like? It was 2017, like trying to explain that to somebody.
So it was they were looking for it. They were in the midst of closing an equity round, and so they wanted to raise some money. So another use case, and I'm not saying this is ideal, is a lot of times founders want to go from a position of strength when they're negotiating. So to have more cash in the bank where you have more runway, then it gives you more time to sort of negotiate your next equity fundraise. Call it extension of runway, call it going from a position of strength. And that's where, Porter raised some money so they could go from a position of strength where they were negotiating for for their next Series B. And that's where we played a role. And so we explained to them what the pros and cons of course, venture debt are, gave the pitch on, hey, you can dilute less and this helps you sort of, keep the momentum going. And it does, right? Tomorrow, if you're able to show a little more growth or traction, as I said, changes the risk profile, you can even get a higher valuation. So there are companies in our portfolio that have raised loan 8 and 9.
Okay.
And you can see that.
From you?
Yeah, from us.
Oh, wow.
And just from us. And now there I'm doing PR for Inovan. And it's worked out for them where over the life of these 8-9 loans that they've raised, the founders and stakeholders have actually saved a bit on dilution and equity. So...
And usually your LPs would, because this was an NBFC, so I'm guessing most of the LPs would have been family offices.
So in the NBFC, we had just 2 LPs, which was Temasek and UOB of Singapore.
Wow. Okay.
So the history of Inovan is it was Silicon Valley Bank, and then in 2015, Temasek and UOB acquired the business or the book,
so you worked with Ajay at some
as
point,
Inovan. I never worked with Ajay. I joined after he left.
Acha.
Yeah.
He was one of our very early guests in the Money Talks, by the way.
Yeah. And I mean, I'm very used to see him. So I knew Ajay a little bit because of Mumbai Angels.
That's true. That's true. And so you were saying that, okay, so you only had 2 LPs.
Yeah. So in the NBFC, it was Temasek and UOB, and it was sort of, they were the stakeholders. Now we have an AI fund structure, 200 million. And there we have family offices and bunch of HNIs and founders in the ecosystem as well. So that's a huge validation that they came in.
And I think I have a very interesting question because we spoke a lot about returns in the previous podcast as well. One of the concerns that always happens in the Indian ecosystem is that we have this thing that main khud kar lunga. I can do it myself. Why do I need you? Right? And in many ways in debt, because many people have been giving debt randomly for a while, they have the feeling that, I can go to a real estate guy and I can get 2% per month. I've heard all these stories, right? How do you justify saying that, listen, I don't think you can really make money in this asset class by going to a mutual fund or going somewhere else? You can't do this direct. You need someone professional.
For venture debt?
For venture debt.
So I think venture debt is it's a lot about relationship. It's a lot about relationship. It's a lot about understanding the businesses. And again, similar to any sort of asset class, it's a lot about the portfolio approach.
Right.
So between those 3, I think it's ideal if you... again,
get someone to manage it. No, I completely agree.
And a lot of it is about, I think, getting insight and relationship and building that comfort, right? It's also, and not just from, that Tarana may have some insights of who to put money in and she's smart, but also from a founder and the capital equity providers who we partner with, them feeling comfort that, we can work with Tarana because it's debt. Again, you have to understand, when things are not going right at these startups, you need to have a trust factor.
Correct.
And is it a known or an unknown who I can work with, that, okay, if things are not going right, is she going to, or he work with me?
I also feel is it easy to build a portfolio? Like I just listed your portfolio, I was in my document here, it took me 2 pages to finish it. Right. And so there was a very much portfolio approach here. And I don't know if anybody can do that kind of a portfolio with the kind of hand-holding or kind of deep, in-depth analysis without having a proper team.
Yeah, you need a team. No, and as I said, a lot of it is about picking up the chatter, understanding things, right? You in venture debt, you are wearing an equity hat with debt. So unless you think you have such insights, and I'm not saying people don't, there are individuals who do, and they should. There are people who are smarter, that if you have such insights to do venture equity deals, then maybe you take a chance with debt.
But I'm guessing nobody can write a small check into venture debt, right? It has to be substantial enough for someone to take.
Meaningful. I mean, you can start small, but I think the other thing to keep in mind, again, like I said, is an equity and debt, there's a different hat. One is 0 to 100. Am I willing to take that risk? With debt, you have to think, okay, recovery of capital.
That's true.
So, you have to sort of balance that out as a individual as well when you're considering it. So something, sometimes what people miss is you're probably taking equity risk for debt-like returns. If you're giving debt to a very early company because you think, I know it all, and it could work out. It's a gamble, but just keep that in mind.
Also, you talked about this, even before when we were sitting having lunch, that it's also very important to have the discipline to exit. Because remember, you're also holding on to warrants of these companies. And many of these companies, I mean, you have great markets to exit, and then suddenly you're not exiting because the IRR looks amazing. But if you don't exit, it could affect your overall IRR.
Oh, 100%. So I've come to the conclusion, though I'm a big fan of Polak and all these Warren Buffett, and feel like, stay in forever. Right now I am playing with other people's money or investing other people's money. That's a responsibility. So I think you have to be willing to also leave money on the table, because I think you can't be greedy. I remember Praveen Gandhi used to say this at Seed Fund. I mean, my dad says it, that everyone has to make money up the value chain. And, we were an early stage fund. If I didn't leave money on the table for someone else, then the growth investors aren't going to come in. The growth investors only going to come in because he thinks that a hedge fund or a public markets guy will come in. The public markets guy is going to come in if he thinks this can be listed. So everyone has to leave something on the table. You have to make it a win-win. And so that's my sort of one philosophy. And two, as I said, it's other people's money. Who am I to decide and just keep it there forever? Giving them something back, just, at least giving their capital back lets me sleep at night.
Yeah, exactly. At least the capital principal needs to go back first.
So in our model, so as I said, of course, as debt, I give the capital, the debt back as the term loan comes back to me, and that gets repaid to our investors after year 4, because we do recycle the money, and after year 4, they start getting principal repayments. But on the warrants, I mean, at some point, you just have to say, this is the time to get out. I've made whatever a few times return on it, and now it's time to get out. And it's a mix of your relationship with the founders, what's doing right by the company, but also just saying, okay, let's get out and let's give this capital gains back to our LPs. And we've been lucky, touch wood.
Now, you had 2 large institutions in effectively Fund 1, you could call it. I mean, it was an NBFC.
Yeah.
And now you're obviously you've raised money from family offices and
they came in as well as significant investors.
But what is the difference in mindset now compared to, let's say, because institutions like Temasek, UOB, already in the lending business, so they may understand the challenges and the opportunities a lot better.
So we do have a little more hand-holding with our LPs. Personally, I feel a lot more responsible, because I'm feeling here there are people who are individuals who've come in maybe on my relationship. And so I feel a lot more responsible that, God, please, I cannot lose anyone's money. So I'm like, so I feel more of an onus that I have to do the right thing.
Meanwhile,
and I'm hoping we can give them the best return.
I think definitely debt is a place where discipline trumps everything, right? And having even if there is, because in equity you might say, okay, if out of 10 things, as long as I'm okay with 7, we're going to make it happen. Right?
Yeah.
We'll figure out the 3 as we go along. In debt, unfortunately, there's no figuring out, right? So because you can go 8, 9, but you can't go. You can't do
go
7.
6. You can't go 5, 6. But you do have to take a little bit of a gut chance at times, because it is venture. Hence the word venture in there, right?
Correct. I'm saying, but it's a very, very little chances you can take. Right?
Yeah. As I said, mortality, as much as possible, you have to manage your mortality.
Because remember, unlike and that's what founders should remember, that unlike, let's say, if you became a $1 billion startup and then your valuation drops to 50 million, right? Well, the equity guys are all going to get squished into that 50 million. The debt guy is not getting squished in anywhere, right? So, and that's the point that needs to be remembered at all time. And I'm only saying this because you're the second venture debt person I've had after Ajay. And I've always felt that, that founders need to be extremely careful and respectful of debt, right? Equity, you should be respectful too, but this is a different kind of respect. You have to make sure that you pay them back.
Yes, you do. I think, but that's where I think we and the founders need to work together to understand what level of debt should the company be taking, and what is the requirement. And
err on the side of caution. I think if you can take 5 crores less, and I know it's against the business for me to say that, but take 5 crores less, and maybe in the next go around, go a little larger.
Yeah.
Because, and like you said, I think that debt is also very habit form. It needs to be habit forming. If your first check itself is 100 crore and you've never managed debt, you don't have a CFO, you don't know how the cash flows are going to work. I've seen companies in my portfolio and outside, not just startups, but listed as well, sort of go crazy with debt.
Of course.
Right? Because it's so easy, right?
That's why there's what was it in business school or in finance? That whole optimal leverage structure.
Correct.
And things like so.
And so now... Let's talk about your own personal angel investment journey, right?
Okay.
So I think you've been investing personally as well. Some of the companies I could find, and somehow you've kept yourself very unknown in the market. I don't know how you did it, but if you could share some secrets, I'd like to erase of the. But so Tarana, you also write personal checks, right?
Small checks.
Small checks. And so you've done, I think, Groyo, Jiffy, Slick. Aloe Health are the 4 that is publicly known. What are the ones that are not listed here?
So there are a bunch of them. There's Master Chow, there's Zeme, which is a hair care skin product. There's Bold Care, there's Genwise, there's DSLR, there's Convin, there's Fixcraft. What else?
SpaceX, I think.
SpaceX and Stripe were sort of later stage deals that I did in the US. So I don't know if I'd call them angel or just,
venture.
Able to just
maybe the venture category.
Yeah, venture category that I was able to stake my claim on. I can't think, but those are broadly the ones that I've done. I know I've done totally 21. I can't.
So when you're now wearing this hat of a venture capital investor, what are sort of the questions you're getting? Are the questions the same or are they a bit different?
No. So as an angel investor, I think the key thing that you bet on is always similar to an early stage investor, is the quality of founder, right? The founder and the opportunity. And if you believe the founder is good, you assume he will or she will make it an opportunity. So I think those are the 2 key things. And then because I'm a small angel investor, I sort of see what check size overall what they're raising and what my contribution is. So, of course there are exceptions always, but am I going to come into a company that's raising, say, 50 lakhs? No, because I don't know what my money will do for them, right? They're so early. I think that's when a founder should be raising, either putting him or her, putting their own money in, or friends and family, right? Because my money may not make or break anything. If they're going and raising 20 million, what is my small check going to do, and what is the valuation there? What value can I bring? So I ideally also see where sort of, ideally in that, where they're raising that maybe $2 to $5 million check size, where I can add value. I can get some stake that could go somewhere, and I can, more importantly, where I can add some value with the founder, right? I'm partly doing it also to sort of intellectually challenge myself that, okay, can I help him beat with strategy? Business strategy, business development, not strategy as much. I think business development or partnerships or help with hiring or fundraising, something. So that's sort of how I broadly categorize, that, okay.
And what sort of help are you providing besides the money?
So, sometimes it's just connecting them to folks, relevant folks, given, I have a decent network, or funds, given, again, the relationship.
And I believe even on the venture debt side, one of the things I've heard that venture debt investors definitely connect you with.
Yeah. It's, as I said right in the beginning, the reason I sort of moved also from equity to debt, and was very clear I want to be in this ecosystem. And one thing that I enjoy is working with the founders a lot. And I think you have to, ultimately, I think in the any ecosystem, playing it forward and being able to just do whatever you can is a huge boon, right? You should just do it.
In the time you've been in the ecosystem though, and you've been in the ecosystem a few years longer than me, many funds have come and gone, right? And you were part of a I think was a great brand, Seed
Yeah,
Fund.
of course,
You were
yeah.
part of MA very early as well. You were also venture advisor to Aureolus and as well as
still.
a venture partner for K.
Yeah,
Right, you've seen all of these brands come and go, and many of these still here. I'm just saying that there are brands that have come and go, but so many that I'm naming that have disappeared. What do you think? Places like K Capital, Inovan, these brands have been around now for over a decade.
Yeah.
What are they doing different that the other fund managers have not? And I'll tell you why I'm asking you this question. Many, in the last 5 years at least, or last 3 years more specifically, many family offices have decided to become fund managers.
Yeah.
Right? They've taken one member from the family. They said, okay, this person is going to become the fund manager. I don't think the mindset is the same as that of somebody who professionally wants to run a fund. Right? And like you said, the responsibility is completely different.
Of course, because family office having your own money and what risks you can take versus when you have other people's money, the onus you feel, right? I think what's worked or hasn't worked, I think one is just sort of building the right team. You have to sort of start thinking as an organization and a partnership. What happens with a lot of funds is I think it's a one-man show.
Absolutely.
And I think you have to sort of think, okay, how do I build an organization? How do I build, similar to an ongoing concern sort of, where I hire the right folks or I get the right folks in who are just as motivated, who believe that we're all working, and they think of it as their own. So I think that's one thing that I think works or doesn't work. And two, a little bit of discipline, even on the equity side, right? You need a little bit of discipline and on just how you sort of build your, staying focused.
Correct.
Maybe it's to your investment stage or the sectors that you're focusing on.
I think we're talking about size of fund, right?
Size
so
of
important.
fund, yeah. Because that can sometimes get you. You may be a great early stage investor, but it's tough to then mimic that in a growth stage.
Correct.
Or give those
with a larger
returns.
fund size.
Yeah, larger
maybe
fund
a great
size.
investor with a 300 crore fund size.
Yeah, exactly.
But you grow that to 3,000 crores, suddenly you can't multiply at the same rate.
Yeah.
At the same
so
pace.
I think that sort of then doesn't, and you have to just, again, I think it's all about sort of also just doing things the right way. I think you're having goodwill in the ecosystem can take you a long way,
So maybe as you look forward, right, what emerging trends do you see in venture debt? Do you because you can fund businesses that have working capital cycles, stuff like that. Now space tech is becoming big.
Yeah.
Right? And we've discussed a couple of my space tech ventures. You're invested in one as well. Is that a good venture to back for venture debt?
So not when they're in R&D.
Okay. Very important. I want to make sure that I bring this up.
But I'm sure we will all do it, including probably us at some point. Unfortunately or fortunately, some companies, if a space tech company or a manufacturing company in R&D has raised 50 million and they come to me for 10, I might just do it. Right or wrong. It comes down to what they're using it for and all. Maybe for CapEx, it makes sense, right? But I would say when they've sort of started to reach production, why not?
Yeah.
At that point, it's a no-brainer. They should then be building the business with debt, right? Why would you use equity money for capacity?
And the reason why I asked that is also, it's not just, I use space tech.
Any of the manufacturing that we were discussing.
Or even deep tech, right? If you're still in R&D, and you have a long road.
Because R&D is a long gestation, and plus you don't know what the success rate is going to be. I think the minute you have some clarity of what sort of the probability is, then
that's the time to approach,
sense.
right?
Yes.
Okay. And I think, what are some of the untapped markets or sectors you believe that venture debt could revolutionize in the next?
I don't know about venture debt revolution, because let's be honest again, we are a derivative of equity. We will follow where the equity guys go.
So
that's the truth.
Would you give debt to ChatGPT?
Would I
type
give
model
them?
In India?
Of course I would. If someone gave them equity money, right or wrong, I would give them some money. I think where we are a little more cautious is, jokes aside, is on the AI or the ChatGPT, where we would want to understand a little bit on the regulatory aspect. Because I would not want to take that regulatory risk that an equity guy may be comfortable taking on sort of how this works out. And it's similar with biotech or any of these, because we don't have the knowledge. I don't have the expertise to sort of, how do I sort of underwrite these again?
And how big is team size now at Inovan?
So we're 16 of us.
16 of us.
So it's a pretty lean team. Yeah.
I think, Tarana, I think this was a great conversation, especially from understanding venture debt.
I hope so.
And from a journey perspective, I think a very interesting career where you've been, you had your journey in the US, then the mid-level management or mid-level to senior level management roles that you did between 6 and 12, and then from there the whole venture journey. And so what does Tarana look like 10 years from now? Let's say we have another podcast. What would you have had to have done in the next 10 years, and you would say, you know what,
Life's worked out.
Life's worked out.
I would say professionally, I should have, made enough money. If I'm
Even more, you got 2 diamond studs in your ear.
Oh, stop it. You cannot put that. But I am a capitalist at the end of it. So, that number has moved. In fact, it's actually come down. Most people, the number goes up. In my case, it's come down because I feel I have less responsibilities on the personal front. So I think just enough where I feel I have the flexibility of my time. I'd ideally like to travel more.
Okay.
But I'd still like to continue being part of the ecosystem. And maybe at that point, more on a sort of helping companies without having to think that I have to make something out of it, and doing investing, maybe an accelerator, whatever, but just doing sort of more pro bono would be ideal.
Okay.
At that point.
You're also independent directors in a couple of,
Yeah.
You've taken those kind of roles as well.
Yes. So I'd love to do a lot more of that because I think it's a great learning. So I think ultimately, I'd want to know that even at 10 years down the road, I am intellectually challenged and learning something.
That's a very, very noble goal to have.
No, it's not a noble goal. It's just I feel like I need
because
to...
I know that you have an incredible, ability to also do some of these extracurricular activities that we might take for granted. Like I know you swim. Almost
That's
like,
because I can eat chocolate every day because I don't have discipline.
But I've seen you run at Marine Drive, right? Even during, I think even in the COVID years, right? You were so focused. I'd be like, hey, Tarana. And you're like, she didn't even say.
Yeah, I don't know if that's good or bad, but yeah.
But how important are those extracurricular activities? Because, our roles are very stressful.
Yeah.
Let's be honest.
Oh, very. So I'm almost OCD about exercising and I'm very shallow. So I think it's important to look decent and good. So I do it purely for superficial reasons.
It's so nothing. Oh, there's no big story over here that I need to get my mental.
No. It's very simple. I like eating chocolate, but I'm so judgmental that I can't be fat. So then I say, okay, I have to eat and delete it. So
fantastic. So Tarana, thank you so much. I think this journey through, and thank you so much for being candid about the journey. And also, I think in many ways, maybe when I had Ajay on the show, venture debt, even for me, was a very new asset class, and I was still trying to understand it in 2020. Today, it's obviously much more better known.
It's much more accepted. There's a lot more awareness.
Yeah. And I think the fund sizes have also, you're hearing like 200 million, 250 million, 3,000 crore funds being raised.
Yeah.
So it's getting to become a much more mainstream asset class that's coming up. So as the next section, right, in the Money Talks, and we end with this, is always a rapid fire round.
Okay.
Right. So there's no hamper though, by the way. So if there's any hamper expectations, we can find sponsors who can give them to you.
Okay, done.
But
from the Artha portfolio.
Actually, we should have can we do this? We should put together a hamper of Artha goodies. Right? Let's do that. Okay. So good. That's it. Thank you so much. When you come back, 30 episodes.
I'm doing 10 years.
No, we'll send you this. For this episode, we'll send it to you. But by the time we'll credit that to this particular moment.
Done.
But that being said, rapid fire is very quick. I'm going to ask you a question. Whatever first comes to mind, just blurt it out. And if we find something interesting, we'll just get a little bit deeper into it.
Sure.
So first question, what's the first action you undertake after waking up?
Swimming. I get up.
The first thing, as soon as you wake up, what's like some people check their phone.
Check my phone. Horrible. Check my phone.
Myth or reality? Work-life balance is possible.
Reality.
It's possible?
Yeah.
So far, you're the first person who's ever said that to me.
No, it's possible. I think it's possible.
So how do you achieve it, if you could?
I'm insomnia. So that's how. Because I don't sleep much, I'm able to achieve it.
So there you go. You have a secret hack.
I don't know if it's a good or bad hack, but yeah, that's...
Who's your favorite superhero?
My favorite superhero or Superman.
Superman.
Yeah. Most people say Batman, right?
Yeah. No. But I thought you would have said Superwoman.
No, Superman. I'm not politically correct.
One question you wish investors would ask more often?
I think founders ask who?
Like you as an investor getting asked from other investors, like people that are investing in you.
Do a total ref check on me. Personally, professionally, all aspects of the individual to know their character.
And what about the other way? So you wish that people would ask more of founders?
Same. I think, we need to not separate between someone's professional and personal character. and we tend to do that.
But it's so difficult in the angel world, right? I mean, and I'm not sure
difficult.
when you're writing bigger checks, maybe you get a lot more time face to face.
Yeah.
But I'm not talking about me personally, but I'm talking about most angel investors out there today are all investing through these platforms, and it's just...
For them, it's probably tougher, but then they're relying or piggybacking on someone to be doing that, right?
Mm-hmm.
So, but whoever's taking the lead.
And how would you recommend they do it? Take them out for dinner, take them out...
Yeah, why not? I mean, if you read, I mean, I listen to a lot of US podcasts and I can't quote the names, but very well-regarded individuals, and they talk about it, right? They take someone out for dinner, they see how they treat the staff, how they talk to people, how you're treating other individuals. And this you can only pick up in a environment. And of course, you have to sort of dig deeper as well. I mean, people can put on appearances for a dinner, but exactly, right? How you order, how do you address someone, all those
I've always found
aspects.
just
eye contact.
Just dropping by someone's office, unannounced.
Of course.
That's always the best way to find out how things are.
Not a bad idea. But they should be there.
That's exactly what I want to know. What's the last book you read that had a profound impact on you?
You know what? I like A Gentleman in Moscow.
Okay, what do you like about that book?
I love the character.
And that's a fictional book.
Yes. So I prefer fiction
Okay.
any day to non-fiction.
Versus self-help.
Yeah. Those self-help books don't work for me. None of them have ever worked for me.
I just love the candidness, by the way. Okay.
No, it just shows I need help.
So, and I think I know the answer to this one. What's the one meal you could eat forever? Is it chocolate or?
Probably, yeah.
Probably.
Yeah.
Okay. What's one company in your anti-portfolio that rankles you even today, that you should have done that investment?
From Inovan or Seed
No,
Fund?
from your own personal portfolio.
From my own personal portfolio. Early days, but I had been, from my angel, I had been asked if I wanted to do Simplify, this company that we've actually now funded from Inovan.
Acha.
It's in the chemical specialty, B2B. Still early. I could be wrong, but looks promising.
Couple more to go. What's the one app you are obsessed with at the moment?
It's a toss-up between Instagram and LinkedIn.
Instagram and LinkedIn.
Yeah.
Wow, those are two completely
Complete
different.
extremes.
But you know, honestly, they're getting too similar to each other.
Yeah.
Right? I feel some of the stories on LinkedIn or some of those posts on LinkedIn are getting extremely personal, right? And things that should not be shared on professional platforms.
Yeah.
What's a hobby, talent, or skill that most people would not know you possess?
Oh God, I wish I had any hobby, talent, or skill that people knew I didn't possess. I'm pretty ordinary. I don't think that I have any skill that...
People running on Marine Drive in the morning and swimming. I don't think that's a very ordinary skill to have or ordinary talent to have. Is there anything that you like? Do you like music or anything like that?
Oh, I suck. I mean, the only thing I can say is that, I can function. I can function with zero sleep.
Zero sleep. Wow. Okay. And let's call that as a skill. A quote or a song that motivates you on a particularly tough day.
I don't know about motivating me on a tough day, but I love the quotes from a lot of Tom Cruise quotes. So I love the
like show me the money.
Show me the money. I feel the need for speed. I think that's one of my favorite quotes.
My last two questions to you. What is a piece of advice or counsel, as I would say, that has guided you through the years, and who gave it to you?
I think it's maybe a mix. I think my mom telling me that impossible is in the Fool's Dictionary and you just have to take chances.
Impossible is in the Fool's Dictionary. You just have to take chances.
I mean, both. But, like just go out. There's nothing that's not possible. So you just...
As long as you try.
Yeah.
Okay.
So,
and last question. How would you measure your life?
Oh, God, that's tough.
The toughest questions are last.
Yeah. Well, how do I measure my life? Well, both personally and professionally, how content I am. And right now, I'd say I still have to figure that piece out. It's mixed. Ask me in 10 years.
In 10 years, when we have you back, for sure.
Yeah.
But thank you so much, Tarana. This has been a fantastic interview. I think I really love the candidness with the views you have, and very unapologetic in many ways. And that's definitely a word that always comes to mind, because there's a lot of confidence, I think, also because you've done so many different things and the experiences you've had. Anything you would like to say before we, like a last message to those that are listening?
No, I don't think I have anything last bit, but just make sure you tweak some of that stuff so I don't get into trouble with my peers.
We're not tweaking this last part, by the way.
So I don't get into trouble on a couple of things.
Thank you very much. And we'll be back again with the next episode.
Thank you.
Bye.
Bye.